Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Time to load up on oil and gas stocks again. Oil is back as an inflation issue. West Texas crude going 20% more in the last year or so. We're moving really fast. Joining me to discuss is Jan Van Eck. He's the CEO of Van Eck, who manages the Van Eck Oil Services ETF and many other commodity ETFs. Also, Fiona Bohl is the global head of commodities and real assets at S&P Dow Jones Indices, and Chris Hempstead is from Mirae Asset Management. Jan, your oil services ETF up 32% this year, one of the biggest ETF gainers out there. Global energy sector is still roiled by this precarious position in Europe, demand questions over in China. What's your best guess on oil?
Oh, we love it as a multi-year play. Again, yes, the Ukraine war, I think, is kind of a little bit of a head fake for longer-term investors, but there are major supply constraints to the energy markets. And so we see $80 as almost like an OPEC plus put price, just like we had the Fed put over the last decade. I think we've got the price put on oil, and that will help the energies get revalued over time. So I think, listen, the overall equity market is being hurt right now, but we love oil services even going forward. Fiona,
what about the alternatives that are out there? Oil prices, as we've been talking about, more than doubled this year. I'm looking at natural gas. We've gone from $3 to $10 this year. We're in the sort of mid-sixes right now. The Europeans are trying to get themselves off Russian gas, even though they spent decades trying to get themselves on Russian gas. Interesting dichotomy there. How does this end for natural gas? What are your thoughts?
I mean, arguably, natural gas ends up being the new oil, right? It's the commodity that we spend the most time looking at. It's the one that has the most direct impact on global economies. And I don't think we thought that was going to be the case even 12 months ago. But in Europe today, the price of natural gas is really driving a lot of the economy. And it's the price that consumers are looking at and starting to understand.
Yeah. What about the alternatives? What about coal and nuclear that are out there? They're unpalatable, I know, to a lot of people, but Germany is scheduled to cease nuclear energy production at the end of the year. Are they going to revive it? Where does all this go from here?
I think they're really in a difficult position because, as you said, these so-called dirty energy sources really are unpalatable. Particularly in Europe, we're seeing that push towards the energy transition. But at the same time, you're dealing with the issue of having to be able to heat homes and keep business going over the winter. So we've seen a shift back to some of those less desired energy sources. But I would expect that that's relatively short term, that in particularly again in Europe, that we will see the move back to the push towards investment in infrastructure and renewable sources.
Let's hope so. Chris, what are you going to tell your clients who want to invest in energy? Energy was almost 30% of the S&P, 30, 40 years ago. Remember, Exxon was briefly the biggest company in the United States 30 years ago. Even with this year's rally, S&P Energy is only 5% of the S&P 500.
It's remarkable.
How do you play this?
It's really interesting to see, and I think you got to continue to play it. Energy's been strong. I think it's going to continue to be strong. If you look at the analyst rankings, I was playing around today on ETF Action's website. If you look at the 33 energy ETFs that are out there, almost all of them, when you're looking at their underlying components, have analyst buy ratings and overweight ratings. If you look at even with the rally in the in the energy sector, despite the rest of the broader market going down, the PE multiples are still rather low. I think that might be what's driving part of the analyst community to be buy and overweight. In addition to that, Bob, you forget sometimes that China is still in a very large lockdown. When they come out of that lockdown, and they will, they're the second biggest drinker or consumer of ETFs, of oil, we like to say. So the demand will pick up even more. So I don't see any relief in demand for oil or gas. I actually think it's probably going to get worse.
And where do you think we're going to be? You run an ETF, so people are interested in obviously the stocks here. Talk to me about energy stocks.
Yeah, no, I think, well, look, oil services stocks, we project will have an earnings increase next year of 20%. I mean, how rare is that going to be in the markets, to Chris's point, right?
They're up 60% estimates for the fourth quarter year over year. I mean, it's amazing.
Well, it's a good turn. It's about time that they turned around. We had to do a reverse split on OAH a couple of years ago because these stocks were on their deathbed. But I think what you and Fiona were talking about is actually one of the most critical, this not my backyard. It's the supply constraint. No one wants nuclear. No one wants solar panels. No one wants windmills. But we need it to do this energy transformation, and that's going to be super supportive for energy over the next couple of years.
Yeah. Fiona, what about distillate products like jet fuel, for example? My understanding is that the stockpiles are at the lowest levels in years. And the margins have remained high because of the heavy demand there. But there's a dearth of refining capacity out there, isn't it? We seem ill-prepared for this in terms of the infrastructure to meet the demand issues that are out there.
That's right. Certainly here in the US, distillate supplies are near record lows, and refineries are running as hard, as fast as they can. And we think, look at what OPEC did last week. One of the reasons they gave for cutting production was that they said we need higher prices to encourage investment in infrastructure, which arguably, has been lacking in the traditional energy sources for the last, well, maybe at least the last decade.
Yeah. So Chris, what are we telling clients now? I'm still trying to sort of sort this out. I mean, it used to be you wanted to buy the oil service suppliers in a period like the earlier part of the year. That seemed to be a good bet, but the entire commodity complex sort of lifted out of nothing.
I mean, the hot button right now, there are two big buzzwords. Inflation is a big buzzword. How do we keep that in check and let the Fed continue to try to do that? And the other one is climate change. Climate change is a trigger. And if you look at some of the broader climate change impacts that we're seeing right now on the Mississippi River, in the growing basin in Arizona that feeds off of Lake Mead, these infrastructures weren't built to support the droughts that they're seeing right now, what they call mega droughts. It's not going to help with the fight against inflation. And add to that, our oil reserves are very, very low right now. And in addition to that, we're not producing more than what's demanded. So if we can fill those reserves, maybe help mitigate the price of energy, that's just one piece of that inflationary fight. But as you know, there's so many pieces to it, and it just doesn't look good.
Yeah.
The most interesting point to me is that we've drawn down half of the strategic petroleum reserve over the last year. So at this pace, we will have
you got a chart along to show that.
You're talking about
amazing.
It's amazing. Like you were talking about inventories with Fiona.
There you go.
It's insane. So in a year, we will have no reserve left. So this whole supply.
Well, you're saying if we continue this trend,
right?
But you can always replenish it. Do you expect that to happen?
Do you?
Well, yes.
And oil prices with 80 or 90 bucks a barrel, I mean, it's going to keep going.
What incentive?
And this is government manipulation of prices. Prices are cheaper because of this than they would be ordinarily, right? So it's just bullish, multi-year bullish for the energy markets.
Yeah.
I was going to say that I don't know what incentive the U.S. oil and the Canadian oil manufacturers and producers have to increase production with oil going up as much as it's going up. I mean, it's landing well in their pocket right now.
But your point, Jan, is we've had these tough markets. We're tough commodity markets. We're in a bull market, and it's not mainly because of the Gulf War. It's because of the multi-year trends. There's supply limitations out there, right? What do we need to do to remove those supply limitations?
It's a great setup, right? You had a 10-year bear market in commodities, which we've lived through, right? And now you've got multiple years, I think, of reset because the supply is constrained. Everyone is yelling at these oil companies, including the government, don't drill more, don't produce more. You have natural depletion of like 9% a year. So they need the oil services companies just to keep the same level of production, right? That's just the nature.
And yet, Fiona, the oil companies are saying we are going to be disciplined. This is the word they use. And the subtext is, you people, you all tell us to go out and pump like crazy. Then demand changes, and we're left with holding the bag of the high costs of opening these new wells. No, we're not playing that game. Wisely, if I was running an oil company, I'd say, you investors, you got a very short memory. So what is the response? Should oil companies go all whole hog here in the United States and tell the government to stay out of the way?
If you're a publicly listed oil company, your shareholder has been telling you for the last 5 years, fix up your balance sheet, pay me more dividends, stop drilling for oil. So really where the response might come from, or might have to come from, is the sovereigns. But again, if you look at the OPEC Plus members, they've got very little spare capacity as well. But the price of oil needs to be high enough for those guys to invest in additional oil wells, potentially at the expense of the publicly listed.
What is the right price? I mean, what does it cost for the Saudis to pump oil?
Oh, I was going to say close to nothing, but very, very little.
$25 or something.
Single digit.
Single-digit dollars,
yeah. Somewhere between $5 and $10
but still,
a barrel.
they want to maximize their profits, right? So if it's a tight market, they're happy to cut back production.
Yeah.
And they realise that there is a clear end game to their ability to make money out of oil. Right? They play a much longer game again compared to a publicly listed company, and so they want to maximise their returns today.
Right, Chris?
One thing you want to remember too is getting the oil out of the ground is sort of this ongoing thing. It's like a river. It's the stuff's coming out. They turn the faucet on and it's coming out. The oil that comes out of the ground isn't ready for your car. It's not ready, to be used for consuming for energy. It has to be cleaned and refined. And then depending on where it comes out of the ground, it's very different kinds of oil. Some are really, really dirty and some are sort of clean. So you have to keep that in mind when we talk about refining capacity, which we just addressed. Refining capacity is full tilt right now. So in terms of, they're using 100% of refining capacity, so there's nowhere to actually refine some of this oil, or not enough of it, and turn it into gasoline, which could help our bottom line. The retail or the commoner wants to fill up their car with gas and buy goods and services that don't cost a whole lot more because the cost of getting it to us has gone up so much. So the crude is just the first part of it, and then it's what happens downstream.
I want to end on a point with you. I'm going to give you your pitch here on bonds. I've been talking to Jan for 20 years about commodities because he's my commodity guy, and we're friends for 20 years. And I call him up. I said, let's talk about commodities. I said, are you excited about commodities? He said, actually, I'm more excited about bonds. This really threw me off. Tell me why you're excited about bonds.
Look, I looked at the last 100 years of U.S. history. The worst, rising interest rate environment, the worst decade for rising interest rates was the 1970s. And forgetting glorious gold and commodities, what did the best? Bonds. And why is because you get this at higher rates, which we have now, you get the reinvestment of the income, and it's just a safer bet than equities. So that's
I think that's
your
going
competition.
to outperform stocks not only this year for the next
from here for several years. It's very possible.
That's
until
like the
you
1970s that actually happened.
Until you get cheaper valuations, and the risk is way less. The drawdowns on bonds, right? So when you look at client statements, you look better.
All right, folks, there you go. Jan van Eck, the commodity expert, pitches bonds to you. Okay. That does it for this week's ETF Edge. I'm not saying anything. My thanks to Jan and Fiona and Chris. We've asked Jan to stick around to give us more insights into hopefully gold and agricultural commodities. I promise not to ask about bonds for the ETF Edge podcast. That's coming up. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.